Good morning, good afternoon, good evening, wherever you are in the world. My name is Elizabeth Anderson, and I am the Executive Director of the Basel Institute on Governance. It gives me great pleasure to welcome you to the launch of the 2025 Basel AML Index. It's a commonplace to say that if you want to change something, you have to measure it. This is certainly the case when it comes to money laundering and other financial crime risks. The work of measuring risks is important for at least three reasons. It forces us to be conceptually clear and rigorous about the problem that we are trying to measure and its various elements, causes, and manifestations. Second, measurements can provide a powerful diagnostic of the problem and what the major drivers are behind it. And third, it helps us benchmark progress and hold ourselves accountable as we work to address the issue. At the Basel Institute on Governance, we are very proud of the contributions that the Basel AML Index makes in all of these ways. I'm delighted that you have joined us today to hear about the latest findings, what they tell us about the state of the fight against financial crime, and how they can be used to drive change. This work is led at the Institute by Dr. Kateryna Boguslavska, Head of Financial Crime Risk, under the leadership of Iker Lekuona, Director of the Institute's International Center for Asset Recovery. My huge congratulations to the team for the launch of yet another index and this important work they do. Now I'd like to turn it over to Iker, who will introduce our distinguished guests and moderate today's session. Thank you.
Thanks, Betsy, for those opening remarks, and welcome all to the launch of the 2025 edition of the Basel AML Index. As Betsy mentioned, I'm the director of ICAR, and I'm very excited to be the moderator for today's launch event. As many in the audience know, the AML Index supports financial institutions in assessing money laundering and broader economic crime risks, but it's also a global reference for researchers and policymakers. Increasingly has become a key tool to support our partner jurisdictions to prepare for FATF evaluations, also to support their efforts to be removed from the FATF grey list. Katia and our local teams have supported several countries in this way. And in fact, we recently celebrated Mozambique's removal from the grey list just a month ago. So now allow me to walk you through the agenda for today. First, Katia will present the findings of this year's public edition of the Basel AML Index, and then we'll welcome our three distinguished speakers to discuss this year's findings. These are Ned Conway, who's the Executive Secretary of the Wellspring Group. So welcome, Ned. Jean Phillipo-Priminta, who's the Director General of the Financial Intelligence Authority of Malawi. Warm welcome, Jean. And last but not least, Nico Di Gabriele, who is the Senior Team Leader responsible for digital finance at the European Central Bank. Welcome, Nico. So thank you to the three of you for being part of the launch. It's really truly a privilege for us to have such high caliber speakers contributing to the discussion today. Now, before I hand over to Katia for the presentation, very quickly, two housekeeping points. The first one is that you'll see that there's a Q&A chat function that I encourage all of you to use to pose questions. And the second point I wanted to make is that the focus of today's discussion will mostly be on global trends. Now, for country-specific questions, we'll ask you to please send us an email at index@baselgovernance.org. And now, without further ado, over to you, Katia, for the presentation. Thank you.
Thank you, Iker. Just give me a second. I will start by saying it's my great pleasure to present you today the findings of the public edition Basel AML Index 2025. But before we go to the key results and global trends, I wanted shortly to remind you what is the Basel AML Index and how we measure risks. We started to do it 2012. Since that time, it is still an independent research-based ranking to assess risks of money laundering and wider financial crimes on the jurisdictional level. We never attempted to measure real amount of money laundered in the jurisdiction or across several jurisdictions. We are looking at measuring risk of money laundering at the level of jurisdiction. How we do that? We start by thinking of what is the high-risk jurisdictions in terms of money laundering and wider financial crime. And here we have an answer. The high-risk jurisdiction in this case will be the one with shortfalls in the AML, CFT, CPF framework, with high corruption, bribery and fraud, with poor financial transparency and standards, poor public transparency and accountability, and with weak political rights and rule of law. This is our first line of thinking to answer what is the high-risk jurisdiction. We then apply this thinking into our model, how we measure it. Here we should say that Basel AML Index is a composite index. We use 17 different indicators to first measure score within the domain. As I mentioned, we have 5 specific answers on what is the high-risk jurisdiction of 5 domains. So we measure the score for the domain based on available indicator, and then we assign the overall score for the country. We use the weighting system, which is reflected on this graph, with the most important indicators and domain within the first one on the quality of AML, CFT, CPF framework. All our methodology, including the indicators, are available on our website, and I strongly advise you to consult it. And here I would like to present you with the annual 2025 results. So what we have seen from the data, that global average score in the Basel AML Index improved slightly in 2025. And this improvement happened from 5.3 to 5.28. On this scale where 0 is the minimum risk and 10 is the highest risk. We saw several increased risks for certain regions, and the risk increased and overall for North America and the EU, Western Europe, Eastern Europe and Central Asia, and the Middle East. At the same time, several regions such as Sub-Saharan Africa, South Asia, East Asian Pacific, and Latin American Caribbean, all of them saw small overall improvement. Very interestingly, that Sub-Saharan Africa stands out. First, 70% of the jurisdiction in the region improved significantly in 2025. Second, 6 countries out of the region left the FATF grey list. 7 of the top 10 global improvers this year are also from the Sub-Saharan African region. And fourth, 2 countries, Burkina Faso and Côte d'Ivoire, managed to move from the higher to the medium risk category. While seeing these positive results, the picture shows a slope drift towards the middle. Indeed, improvements among several higher risk jurisdictions, particularly, as I mentioned, in Africa, are encouraging. At the same time, what we've been seeing is that such improvements are often offset by gradual declines, and these declines we see among historically strong performers. Let's move and look how different domains changed in 2025. We see that there was a modest progress in terms of quality of AML, CFT, CPF framework, and the average risk level improved from 5.58 to 5.54. Risk level in corruption also slightly edged down from 5.12 to 5.09. We see the highest notable deterioration in terms of financial transparency and standards, with the risk going up from 5.42 to 5.47. Same comes to the risk related to public accountability. They increased drastically from 4.23 to 4.35. Risks within political and legal area, they are slightly the same, with very, very slight increase from 4.45 to 4.46. Clearly, the situation differs across the region, and the regional infographic as well as key regional pictures are available in our report and also on our website. Please do not hesitate to check and to find some deep dive into your region. As you know, every year we not only look at the numbers and overall score and performances, we also try to take the topic of the most important, to cover one of the most important issues related to global financial crime. This year, we looked at streamlining risk-based approach. And I would be surprised if you don't know that risk-based approach is a key backbone of any efforts in terms of preventing money laundering and terrorist financing and financial crime. Yet what we have been seeing is that in many jurisdictions, public sector as well as private sector, they use the risk-based approach not effectively as it intended to be. What are the key issues is that in most cases, the attention is placed on identifying high-risk clients, high-risk services or products, or high-risk jurisdictions. For example, by using the FATF grey and black list, international sanctions regime, or any high-risk list. By contrast, what we are seeing is that there has been less discussion and less focus about what should count as a lower risk and lower risk areas. Indeed, this gap is very important because when we see and identify lower risk situation, it's where we apply simplified, proportionate measures, and that is the key for the financial institution. Yet we see that in many cases, that lower risk and simplified measures are not implied in a proper way, showing that there is unclear position of supervisors on how to assess lower risk situation. Interestingly, that recent FATF development, they encourage proportionality. They advise jurisdictions to actively use simplified measures where it is appropriate. However, the challenge is still there, and we still have to take this path to move from the conceptual level of what is lower risk to make it operational. This year, the Basel AML Index decided to change its classification of risks. We moved from fixed equal intervals to the Young's natural breaks, and this helps us to provide more nuanced classification, which takes into account actual distribution of data. As you can see on the graph, we moved down from the overreaching medium risk with the equal distribution to more nuanced approach and identification of lower, medium, and higher risk. We also renamed the categories from lower and high to lower, medium, and higher to emphasize that risk is relative. The second topic that we looked this year was related to the assessment of risks related to virtual assets. We know that currently governments and private sector, they are under the growing pressure to understand the risks associated with virtual assets. This is especially true with the new round of FATF assessment and a stronger focus on virtual assets. At the same time, what we are observing that such risk assessment is inherently challenging and difficult. Why? Because the virtual assets are borderless by design. Sometimes, and in many cases, they operate outside of the regulatory environment. And most importantly, we have lack of reliable data on the national level related to virtual assets. We've seen several attempts from commercial blockchain analytics provider to publish broad indicators on virtual assets in terms of adaptation and possible illicit usage. Even though such attempts might be helpful to understand the general trend, we still have to be careful in the interpretation of that result. Additionally, there is a guideline from the World Bank for understanding virtual assets risks in line with the national risk assessment that can serve as a starting point of such an assessment. While doing the virtual risk assessment, we have to remember that virtual assets do not exist in vacuum. The activity, and especially illicit activity involving virtual assets, often exploit the same underlying weaknesses that we see in the money laundering and corruption, frauds, and other predicate offenses within the traditional financial system. Even though the Basel AML Index as such does not provide a dedicated indicator for virtual assets, what it does provide, it gives an understanding of what are the structural vulnerabilities of the country and what mitigating measures the country can apply to tackle risks related to virtual assets. By showing this picture, I invite you to explore more around the Basel AML Index, not only its public edition, but the expert editions that we have. Within the expert edition, you can get deeper insights and country coverage of 203 jurisdictions, 17 different indicators and regular updates. We mentioned several times FATF data, and that is what you can get access through the Expert Edition Plus, where we provide the numerical FATF dataset and analysis. The Expert Edition and Expert Edition Plus are free for all public use, public agencies, media, university, and most of the sectors which we see as public sector. They're available for a fee for private sector. If we look at the usage of the Basel AML Index, it's valuable for both private sector and public agencies. For private sector, it may serve as a standalone methodology to assess money laundering risks and wider financial crimes. It is within the risk-based approach to understand the risks within the jurisdiction. It may also be used as a benchmarking exercise when the private sector already has their own developed methodology. Clearly, the index helps to build mitigating measures and to understand where the country stands. For public agencies, it's also a valuable source of information and assessment. You can see the underlying deficiencies across 17 indicators, with probably more focus on the AML-CFT framework. It's especially important before the next round of FATF assessment as a part of preparation to it. It can also show the performance of countries across different indicators over time and help to mitigate and see the risks of being grey listed well ahead of the actual grey listing happening. Thank you for your attention. If you want to learn more, please go to our website. Here are all relevant links. And if you have any specific country request, please write an email for us. Thank you for your attention.
Thank you very much, Katya, for laying out the key results and the trends in this year's AML index. I'd like to now turn to our speakers. I'd be very interested to hear your thoughts on Katya's presentation, especially what struck you and what would you want to emphasize to your counterparts in your respective institutions or your respective communities of practice. Maybe starting off with Ned, over to you.
Yeah, excellent. Thanks, Iker, and a big congratulations to Katya for getting this out before the end of the year. Must be really fulfilling and very well embraced, of course, by us in the industry. Listen, I mean, my initial impression, there's a great reference in the forward to the kind of a world unsettled that we're living in, and the Basel AML Index has always been kind of an objective anchor for all of us in the industry when it comes to assessing country risk. And, certainly the 2025 edition is that legacy. It's no secret that this is a foundational element for really any major bank's country risk team. And what I think what's really nice about the 2025 edition, as well as the features you have in the expert edition, is that it brings the analysis much further along, but with a lot of transparency on how you got to where you got to, which will ultimately result in a lot of man hours saved within the banks themselves that might do this on their own. So high level response, fantastically objective in a world where finding objectivity is increasingly challenging.
Thank you very much for that very positive feedback, Ned. Now over to Jean for your first quick reflections on this year's results and trends. Over to you.
Thank you very much, and I echo the congratulations as stated by John on the good job done, and also I think a new way of thinking and approaching risk assessments. We've been challenged really on how the cutoff point approach would leave certain granular elements that do not assist us to come up with appropriate measures for the risks that apply to situations and jurisdictions. So it's a very good thing. What struck me first, I naturally had to go on the list and see where Malawi is, and I was glad to see that we are on the decrease in terms of risk. But yeah, one thing that has struck my eyes and my attention is the question of the missing piece. What is the lower risk? I think that's really a new dimension that we would have to also think about and adopt as we move on for Malawi in updating our next NRA, and also preaching the same to our counterparts and the financial institutions or reporting entities and all the other sectors, to say also focus on this. The advantages stated in the report cannot be overemphasized. That instead of just defining everything in terms of what's high risk and what do we prioritize, it helps us also to take off things that we need not to focus on now because we have properly classified them. So I think that's what I would say for now.
Thanks, Jean, for that reflection, and congratulations on Malawi's improved performance. No doubt, in great part down to the contribution of financial crime fighters like you. So congratulations for that, Jean. And now over to you, Nico, for a first quick initial reaction.
Well, thanks. Let me say one thing, that I do consider the Basel AML Index a sort of lighthouse, which is very helpful to have, at first glance, an indication about how problematic a country is. And I say it is on the back of the experience that we have made by using the AML index, because to have a comprehensive picture about jurisdictions that are far away from the place where you run the business, either as a bank or as a supervisor, you need to make quite important investments. The investment you have to make is to get access to the AML index provided by the Basel Institute, because it provides you with a quite comprehensive picture about the situation of a country. Because what should be clearly understood is that the rating that is given by the FATF, it is based on a quite large but not exhaustive set of pieces of information. And you add additional components that provide financial institutions, but also anti-financial crime supervisors with added value. Obviously, the index can be used only if you have understood the logic behind, because with whichever benchmark, whichever assessment you get from a third party, you cannot place blind trust. Not because you are not, let's say, a trustworthy institution, but because the assessment you conduct is inspired by a logic, and the way we conduct our supervision may be inspired by a different logic. So the ranking should be clearly understood, and not all supervisors are in the same situation, because for some supervisors it is more relevant to know what the assessment of the FATF is. For other supervisors, it is more important to understand whether the environment where a bank operates is more prone to corruption or not. Because if a bank is doing a lot of business with the public sector and there is a high level of corruption, probably this is the most important dimension to be looked at, rather than considering whether there is a high level of terrorist financing, which is problematic, but probably not the first concern for the bank and the supervisor of the bank. So all in all, the index is a useful source of information that we consider for, let's say, our assessment, but we understand the logic behind. So the message I would like to pass is that it's important to participate to these meetings, not because people keep listening to me, but because this is a way to grasp the logic, the rationale behind. Because we supervisors well understood with the great financial crisis of 2008 that placing trust on black boxes was a big mistake.
Very much amen to that, Nico, and thank you very much for that reflection. I'd like to now direct a question to Ned. So the Basel AML Index, among many things, it recognizes that we are witnessing some significant shifts in how the risk-based approach is being applied. The Wellsberg Group has provided valuable guidance on this approach in the past, particularly for the banking sector. And I understand that you're currently in the process of updating that guidance. So could you share what the latest developments are in this regard and what is driving these changes? Over to you, Ned. Thank you.
Sure. No, thanks for the question. And first, let me say, Nico, we love hearing you talk. So we do come in to listen to you talk. It's fantastic to hear your insights. Let me pick up on a theme that Jean noted in her opening kind of observations, which is this focus on lower risk, which I also very much welcome. And I think the implementation of the Jenks methodology that has led the index to have this kind of bigger chunk of lower risk is really welcomed. And as Katya mentioned in her briefing, a large aspect of this is the FATF initiative stemming from the reforms they did to Rec 1, which are really trying to get us to think beyond a risk-based approach as just simply high-risk EDD. And that conversation is equally a conversation that we've been having within Wolfsburg now for quite a while, which led us, as you mentioned, Iker, to release a statement over the summer. It's a one-page statement. It basically says two things. First of all, it says we're looking at all of our existing RBA risk-based approach materials, reviewing them through kind of a new lens, because we recognize that they haven't been updated in a while, and a lot has evolved since that time. And two, we try to put our finger on this idea that for us, a risk-based approach is about, it's about proportionality, which is, of course, drawn from the FATF language. It's also about prioritization and allocation of resource. and it's about effectiveness. And that's kind of the lens we're looking at everything through within our side. How does that manifest itself in practice? Just a quick kind of anecdote. I think first, it's not just EDD for high risk, it's also doing less in KYC sense when there's lower risk. But I think our bigger objective is to break out of this idea that for the private sector, RBA is just KYC due diligence, right? And it's there's so much more to how we use the risk-based approach within our financial institutions in kind of everything that we do. That, by the way, like the Basel AML Index can be a big support to. So, for example, if you think about how we monitor for suspicious activity within a bank, we are constantly calibrating our appetite for false positives, missing something versus, false positives against false negatives. So like how we might miss identifying something suspicious versus all these alerts that we have that are basically false alarms, right? And that calibration is very much about risk and risk appetite, right? And I could easily see how the level of granularity that you receive with the Basel AML Index would better inform kind of that calibration exercise based off of where you have your subsidiaries based. What are the underlying predicate offenses that are of concern, which the index does a great job of highlighting. And so there's a lot of ways, like within a bank, where risk-based decisions are being made all the time. It is often the case that a part of that risk-based decision is jurisdiction or geography. And so, for us, the wider initiative here is trying to get the kind of supervisory side, the FATF side, to recognize that RBA is way more than just KYC. And that's kind of where we're focusing our energy at the moment, Iker, and you'll see that through a lot of our engagements and publications over 2026.
Excellent. Thank you, Ned. Thank you for sharing that experience in terms of how banks are thinking about proportionality and risk-based decisions. Now, I'd like to suggest turning to Jean to delve a little bit on the Malawi experience, as Malawi is now preparing for the upcoming fifth round of evaluation, the FATF fifth round of evaluation. And as Director General of the FIU, you are leading the efforts to understand the national risk of money laundering and related crimes. So the question for you, Jean, is how are you going about this? And how will you differentiate between higher, medium, and lower risks as part of this national risk assessment? Over to you.
Thank you very much. Indeed, we have just started out with a roadmap as we move towards 2028 future evaluation. And the national risk assessment and its findings are critical in these preparations and whatever we do between now and 2028. So as we mentioned, we have a 2024 national risk assessment that, of course, fell within the traditional way of conducting risk assessment. So we start with the high, medium, low, those kind of categorizations. I think we did it with the four-band categorization. But now you've taught us with this report another way of doing this. So that's what we'll focus on now in terms of how do we categorize the risks when we're updating this 2024 NRA, because this one will have to update, and the updated one is the one that will be most recent by the time we go towards the mutual evaluation. So, but already with the results from the 2024 risk assessment, we are going now full throttle into awareness raising with all the concerned sectors, but obviously risk-based approach even in the dissemination, risk-based approach in the supervision, and also reaching out to entities or sectors that had never started their work on AML CFT at all. So reaching out to those. But now also something that struck me that I should have mentioned, but is still very relevant now, which will help us even on how we present ourselves for the mutual evaluation exercise, is the missing piece. So the focus on high risk, yes, but what about the missing piece? As an FIU, the issue that if you do not do this clearly and you do not take into account the granular elements, you end up receiving defensive reporting. So would have a huge chunk of statistics of data as an FIU. But then, so you have, for instance, you're saying you received 20,000 STRs, but you're only disseminating 10% of that. A question arises during the mutual evaluation, something is not working. So maybe we lost it during the national, the risk assessment. Maybe we lost it when we're disseminating to the reporting entities. Maybe even the reporting entities missed it when they were conducting risk assessments on their products, on their customers. So they're sending everything. We may categorize it as defensive, but maybe also they don't know. So I think it's a takeaways from this report, but also as we are focusing on the updating the 2024 risk assessment and implementing or sharing the message or the findings in of the 2024 risk assessment, focusing to 2028 exercise, which is largely on effectiveness. So it's an issue of data, which also brings us back to how to conduct this risk assessment. It's an issue of data. So we are still a jurisdiction that is struggling with institutions not keeping accurate, comprehensive, and maintaining such data, which is useful for the risk assessment, but also it will be useful for the mutual evaluation exercise. So also the accuracy in the data, how you're collecting it and how you're applying it when you're doing the risk assessment and updating the risk assessments, but also presenting your story to assessors in 2028. So that's what I would say in brief. Thank you.
Thank you very much, Jean, for sharing the Malawi experience and how you're implementing a risk approach and conducting a national risk assessment, and how you are overcoming some of those challenges. I'd like now to turn to Nico for a question on virtual assets. So the AML Index highlights the challenges of assessing national risk related to virtual assets, not least since these are obviously cross-border. And data is also relatively unreliable or inconsistent. And so drawing on your experience at the European Central Bank, what is your experience assessing risk related to virtual assets, and how have you managed to overcome some of these challenges? Over to you, Nico.
Well, thanks. This is a question that summarizes probably the key concerns regulators have been having over the last 15 years. And probably they will remain with regulators, but definitively with supervisors for the future. The key issue we face is that we live a paradoxical situation. And the paradox of the blockchain is that the industry claims that it is transparent, all transactions are on public ledgers, but in practice this transparency is superficial. And this is not a problem just for anti-financial crime supervision, it's a problem also for prudential supervision, because if you have a return from a bank, you will pretend to check that what the bank reported is true, and you look for the wallet of the bank on the blockchain. But thanks God, I will say, you are not finding on the blockchain a wallet bearing the name of the bank, because this will be a kind of transparency that is unwelcome. The issue is that when you look for the owner of a wallet, if the provider of the wallet is in a FATF, FSB compliant jurisdiction, you are lucky, because by using the appropriate administrative tools, you can get access to the information about the wallet owner. But unfortunately, there is quite a number of jurisdictions that are not fully FATF compliant, not FSB compliant. So the claim of transparency remains on the paper. Plus, there is the factor that is represented by mixers, cross-chain bridges, and privacy-enhancing tools, further obscuring the trail, creating opacity where transparency is assumed. The industry claims that because of transparency, there is no need for regulation, and the ledger itself is a substitute for supervisory oversight. I would say that if there were a solution to make our work unnecessary, I would be relieved because I could, let's say, enjoy more the life. But I am not persuaded of this argument because this argument rests on the assumption that visibility equals accountability, which is misleading. Supervisors need to comprehensive and reliable data to conduct oversight, but also because when we implement a decision that is legally binding, this must be built upon facts, and the facts must be demonstrable, because if the affected party is not satisfied with the decision, with the enforcement, should go to a court and challenge the decision. And with the blockchain up to now, we do not have any decisive argument. What are we doing? Well, first, we have to accept that we are confronting a paradigmatic shift. With traditional finance, we have quite a well-tested reporting framework that helps us to see which risks are building up, where, and because of who. With crypto assets, we struggle to have certainties. The first problem is that we have a fragmented global regulatory landscape. We can collect data also only from entities that are subject to licensing in the Union, and only from those who are already under MiCA, our regulation. Because of the grandfathering option, in certain member states, legislation in place before MiCA still applies and applies until the end of June 2026, and those CASPs are not subject to the reporting obligation under MiCA, which means that there is a hole, a data gap that we cannot fix. Then we have that quite a few entities are new to operate in a regulated sector, and they are still in the phase of building a proper compliance culture, if I can put in this diplomatic way. In conclusion, the quality of supervisory reporting is not as it should. The market is concentrated and the largest players have a vertically integrated structure, which is not a problem per se, but when it comes to transparency, this is a killer for transparency, because the transaction among clients of these players are not on the public ledger, are on the internal ledger of these players. Therefore, missing any trace on the blockchain, you have no tool other than asking these players to provide with information. But if the player is conducting the business outside your jurisdiction, and there is no cooperation of the supervisory authority of the host country, you remain blind. The third issue connected to this is that there is limited supervisory cooperation, despite the tremendous effort made by the FSB, the Basel Committee, the IOSCO, and the FATF. Let me conclude by making a consideration. We have quite good transparency about what banks are doing because there are balance sheets and there are supervisory returns, but this is not the complete picture because we do not see what the clients of the banks are doing. And banks are exposed to financial and non-financial risks because of the business of their clientele. And also banks do not have always the right tools to scan what the behavior of the clientele is, which is a decisive aspect in order to determine whether or not a transaction of a client is suspect and has to be reported to the FIU. But from a banking supervisor is also a source of concern, because if we do not know what the business of the client is, we miss essential pieces of information to estimate how volatile the deposits of that clients are, which is a decisive factor in order to estimate whether a bank has a sound or not liquidity profile. Let me make a short remark. Stable coins, which are the crypto asset mostly resembling traditional finance, are not so easy to monitor, despite the fact that, as I said, they are very close to traditional finance. Issuers are sort of narrow banks. And here the problem is that a large chunk of stable coins are held through unhosted wallets, which creates another huge data gap. And this combined with an emerging issuance scheme, the multi-jurisdictional scheme, is a tremendous issue for supervisors, anti-financial crime supervisors, and supervisors in charge of financial stability. This multi-jurisdictional stablecoin is a scheme according to which two or more entities established in different jurisdictions, they issue the same token and they redeem the token, which complicates dramatically the performance of transaction monitoring, because I may be redeeming a token I did not issue because it was issued on the other side of the world by a partner, but a partner subject to different rules. Needless to say that this keeps us busy because it's a scheme that in certain jurisdictions is fully permitted, in others is still unclear, but we do not have all the mitigants to contain the risk arising from it.
Thank you, Nico, for that very insightful contribution on the complexities of assessing virtual risk related to virtual assets, rather from a central bank perspective. I wonder if Ned, you wanted to weigh in on this question from your perspective.
That was very comprehensive response from Nico and provided really good insights into how he's seeing the issue. So I'll just add quickly. I mean, we, as it regards kind of geographic or jurisdictional risk, we have released guidance on the provision of banking services to stablecoin issuers. That is on our site, and we do indicate in that guidance that one of the factors that should be considered is the jurisdiction. But similar to what Katya said during her presentation, we equally see the regulatory developments as kind of so volatile or changing so quickly that at the moment, the best kind of North Star is the overall, capacity of the jurisdiction to manage AML CFT risk. So we embrace that as well on our side. Certainly something we're looking at, and Nico, I definitely don't dispute, especially your comments at the end on unhosted wallets, which continue to be a big concern for us as well. But generally, from a jurisdictional risk perspective, we're very much aligned with the direction of travel of the AML index from Basel and looking at the overall health of the country itself.
So we have 10 minutes left, and I wanted to ask a follow-up question to Nico in terms of there's something that we see through the indexes that criminals who misuse virtual assets for money laundering tend to exploit the same structural vulnerabilities that enable other abuses of the financial system, right? So does that align with what you see? And if so, what would your advice be to jurisdictions that are seeking to develop regulatory and supervisory frameworks on virtual assets? This is a question that's very dear to us because a lot of the jurisdictions that we support, we find that the regulatory frameworks are very, very much underdeveloped. And so what would be your recommendations in this regard?
Well, I must say that unfortunately you are right. And it would be preferable to be wrong because illicit actors, we have to bear in mind that frequently they are smart and sometimes even smarter than people going after them. And they are always in search of the weakest regulatory, but also supervisory links. And I must say that they are quite good at that, also because not all authorities around the world are adopting the right measures. Clearly, there are countries suffering from capacity gaps, and they need to rely on assistance from international bodies. Technical assistance is of paramount importance, but there are also countries where the political will is not oriented towards closing gaps. And this is something that we have to factor in because we can have the best regulatory framework, the most effective supervisors, but if we cannot collect inputs from abroad, if we have no cooperation from key partners, we are somehow ineffective. And with crypto, this is magnified. What we see but let me say that this I speak from a financial stability perspective, banking supervision perspective, but has stronger resemblance with the anti-financial crime domain, are two patterns. One is based on an entity operating from a country with a permissive crypto regulation and possibly also lax supervision, because these are two very important ingredients. This entity leverage the badge of being in a country with a regulation and then tries to expand the business in neighboring jurisdictions. The FSB and as well as the FATF have been raising the attention on this practice. The FSB with a report on CASPs operating from offshore jurisdictions, and the FATF with the 6th targeted update that was released in June this year. And then there is a second scheme, which we see also in Europe, because we are not different, and entails a foreign group establishing one or sometimes more subsidiaries, which are somehow empty shells. And in certain cases, the foreign group was subject in the own countries to penalties for lapses in AML controls. So you have an entity that has already attained the reputation entering in a new jurisdiction with a shell company. And it is quite frequent that these shell companies have complete reliance on services from treasury management to transaction monitoring on the parent company. And the consequences when these services are not delivered in an appropriate manner are unfortunately felt in the host country. The penalty recently imposed by the Central Bank of Ireland in November is an example of the consequences of this practice and the implications. But this penalty, the enforcement measure, is also an example of what authorities should do and could do: deploy technical and human resources to conduct supervision. Authorities should focus on entities that are material, not necessarily within the country, but on a global base, because with crypto, you do not have any certainty on whether or not the business is conducted on your country. But if in your country there is an entity that is big on a cross-border basis, look at that. Well, the risk-based approach is a concept frequently abused, but I will keep abusing of it, because we have to look at where the risks are and what the big fish in our pond are. And we have to consider that the rogue actors, they come first in exploiting regulatory gaps. And if there is an understanding that there is a regulatory gap, we supervisors should lobby the political level to ask that legislation is passed or legislation is amended to close the gap, because not all solutions are in our hands. Some solutions can come only with the cooperation of the legislator. This is the strong advice I will give.
Thank you very much for that advice. Now, in the last final minutes, we still have some minutes left. I propose we do a lightning round and ask maybe a slightly controversial question. I mean, some people say that the AML CFT system doesn't work. They say it's not enough to tweak it to apply to virtual assets, and that it's not enough to adapt it to be applied more proportionately for lower risk jurisdictions. So in 1 minute each, do we need an overhaul of the AML CFT system, or are we largely on the right path? Maybe starting with Jean, over to you.
Well, I would say, just as the initial question on the criminals exploiting the already existing structures when they're dealing with using virtual assets to commit crime, it's the same structure that exists already in the AML CFT space. So no, what we have would work, but obviously it has to be tweaked a lot, because standing on the side as a supervisor, I'm looking at having a complete set of tools that I'd have to use to check compliance on the reporting entities. And also now for the reporting entities to have a complete set of tools, the traditional tools on compliance, AML CFT, that is used for fiat money obviously does not work. And I think that would explain why laws have been adopted just to tick a box on the technical compliance with the FATF recommendations, but implementation has been difficult because you have the law, but as a supervisor or as a public entity, how do you go about implementing this, and what message do you pass on to the private sector? So tweaking and a lot of tweaking.
Thank you, Jean, for that constructively critical support of the system. Over to you, Ned.
Yeah, thanks. Just quickly, I would say that first of all, the good news is that I think the necessary resources for resolving the challenges are there. So, you know, if you look at the resources and the financial and human resources dedicated within the private sector or in the public sector, I think we have the resources we need, which means the conversation is at a high enough level where there's recognition of the financial, human, technical capacity we need. It's about redirecting those resources to the right areas, and that very much falls in line with what Nico is saying with respect to the risk-based approach, risk-based supervision, risk-based decision making. So I think for us, the big challenge there is the reallocation and the redeployment of that existing resource to the right areas, not increasing the resource.
Thank you, Ned, for highlighting the need for that prioritization. Over to you, Nico, for your final contribution.
Well, I am going to repeat something that I said probably last year and the year before. I am not that much in favor of reshaping the regulation, because the regulation has to be understood and this takes time, and also supervisors have to deploy the right tools against the background of the regulatory framework they have to deal with. What is important and is still missing is the application of the right controls at the entrance into the market, because frequently it happens that people who have attained the reputation are permitted to be qualifying shareholders, directors or senior managers in gatekeepers. This should not happen, because if you let people with attained reputation, and sometimes when I say attained reputation, I talk about criminal convictions operating in the financial sector, there is no rule, there is no supervisor capable of mitigating the consequences of this. So looking better at the rules we have and enforcing them seriously is probably the most important thing from my humble point of view.
Thank you, Nico, for thank you, Nico, for those final reflections. And this brings the launch event to a close. I wanted to thank the team behind the AML Index again. Very special thanks to Katia. She works really hard all year long to ensure that the AML Index continues to deliver global impact. Also, sincere appreciation to the communications team, which is led by Monica Guy. They do an outstanding work to effectively communicate the key trends and ensure the advocacy messages that arise from the AML Index are well understood by diverse audiences. Thanks also to our three brilliant speakers and all of you in the audience for your participation and continued interest in AML CFT issues. We look forward to working with all of you to turn the AML Index into global action. Fighting financial crime demands collective action, and we feel privileged to stand alongside you in this effort. Thank you very much, everyone.
Thanks.